be aware of. The first is the specified service business test, which says if you are a service business and you are specified on what's essentially the bad list, if your business is on the bad list, you don't get the QBI deduction once your income goes over that threshold. And the bad list is this. It's directly out of the Internal Revenue Code, Section 1202E3. Any business performing services in the fields of health, law, accounting, actuaries, performers, consultants, athletes, financial services and brokerage services, which unfortunately includes all of us on the call, and any trade or business where the principal asset of the business is the reputation or skill of one or more of its employees, which is sort of a big catch-all net for like any other personal services industry similar to health, law, accounting, performers, and consultants that didn't get caught in the list of health, law, accounting, actuaries, performers, and consultants, etc. Notably, if you actually look up the original Section 1202E3, there are actually two other professions that are normally listed here, engineers and architects. They are not subject to this limitation, though. Their lobby successfully persuaded Congress that at the end of the day, engineers and architects aren't just in the service business. They make things. They make prototypes. They make blueprints. They have a physical deliverable, so they shouldn't be subject to the rules. And, while we can debate that, they successfully convinced Congress, so they got protected. Everybody else is subject to it. But you only have to deal with this if your income goes over the thresholds. So I'll give you some examples of what this looks like. Andy's a 50% partner in an advisory firm that made $300,000 last year. So Andy's portion of the income is $15,000. I'm going to assume he's got like $17,000 of some other portfolio income from his savings and investments. So if I look at Andy's tax return, his qualified business income is $150,000. His total income is $167,000, including the other portfolio income. He gets a standard deduction of $12,000. His QBI deduction would be 20% of his business income. So 20% of $150,000 is $30,000. His taxable income would be $155,000. That's $167,000 minus the 12. And since $155,000 is not over the thresholds, he gets the whole $30,000 deduction. And so his actual taxable income in the end would be $125,000 once he subtracts the 30 off. Now, another example of what this looks like. Still Andy, 50% partner in the business. His QBI is $150,000, but he has no other portfolio income. So now his qualified business income is $150,000. That's his total income as well. He gets this $12,000 standard deduction, $30,000 QBI deduction. His taxable income is $138,000. But again, the QBI deduction is technically 20% of your business income or 20% of your total income. Well, 20% of his total income would be 20% of $138,000. That would limit his QBI deduction to only $27,600 instead of the full $30,000. So this is an example where, and you will see this, if clients are business owners, but their only income is the business and then their deductions go against that, they'll end up losing a little bit of their QBI deduction. It won't go to zero, but it'll be reduced. Now, in the extreme, though, it can go to zero. So Charles is a financial advisor who last year earned $275,000 as a sole proprietor. His wife is a lawyer who earned $170,000 as an employee, W-2 wages. So their qualified business income is $275,000. Only Charles's income accounts, not his wife's, because his is pass-through income as a sole proprietor. His wife's is not as an employee. Their total income, though, is $445,000. Standard deduction for a married couple will be $24,000 this year. Their QBI deduction would be $55,000 because that's 20% of $275,000. But their total income after deductions before the QBI itself is $421,000. That's just $445,000 minus the standard deduction. $421,000 is over the phase-out threshold, and since financial advising is a specified service business, their actual QBI deduction is zero. And so this is a good example of if you're in one of the bad businesses and you earn too much money, you just flat out don't get the deduction. And even though Charles's income wasn't too high, their household income was too high. So his wife's employee income actually offset or eliminated the QBI deduction on his business income. And this is an important thing to be aware of, that any household income, it could have been a capital gain, can disqualify the income because all of that goes into taxable income to calculate the threshold. Now, the second limitation is what's called the wage or property test, and it limits the QBI deduction to either 50% of total wages for the business, not just for the business owner, but everybody, or 25% of wages plus 2.5% of the basis of property. So examples of where this plays out would be things like, I run a landscaping business, and I've got a bunch of part-time laborers that I pay as independent contractors, and then a full-time operations manager who makes